All right, everybody, let's get this webinar started. Our next webinar is Commodity Ties Take Me to the Gulf. So thank you, everybody, for joining. And this one, we're really going to focus on the area that we call the Gulf, which is basically the Permian. You got the Houston Ship Channel, Eagle Ford, and you have the Haynesville. So thanks for joining us, and we're in for some exciting topics. So here's what we're going to cover in this one. First, we're going to bring back Maria, and she's going to cover our 2025 U.S. production and Gulf Coast production outlook. Then we're going to get into rig activity and the Haynesville ramp. With crude, we're going to talk about some dynamics we're seeing with crude going north and why that is. NGLs, it's all about controlling the molecule. So we're going to be talking about that. And then we have a whole section on data centers. Clients, you guys have asked us about data centers, so we're going to cover some things we're seeing and tell you about a new product we're rolling out soon. And then for natural gas, the convergence of data centers, LNGs, and just utilities in general in the Southeast and what that means. Specifically, we're going to be moving over to Transco Station 85. So with that said, I got one more slide before we move into production. We are coming out with a DLS written report. Should be early January, late December, but we're going to cover some topics in that we think are really interesting. And I'm gonna seed you with one to hopefully get you to sign up for it. One topic we're going to be looking at is why integrateds would consider becoming more integrated. Hence, why would they want to control the full value chain? And not give up some of the money they're missing in the middle part. So we're calling it bringing back the 80s, integrated's getting more integrated. And then we have a couple other sections in there as well, but that one's really interesting. And we'll also have a section on data centers. So to kick it off, let's move forward with just production in general. Joining me now is Maria. You remember her from the last webinar. She'll also be covering our NGLs today. Maria, thanks for joining me.
Thank you, Chris.
All right, so let's kick it off again like we did in the last webinar with just overall U.S. production and what we're seeing.
Yeah, so we expect growth across the three commodities. On the natural gas side, we see 2024 averaging 109 BCF per day and increasing to 113 by 2025. The main drivers are the Permian, the Northeast, and the Ark-La-Tex, which account for the vast majority of the growth. If we look at crude oil, we see 2024 averaging 10.2 million barrels per day and increasing to 10.5 by next year. The main driver is the Permian, which was waiting for gas egress constraint to ease, with Matterhorn coming online on October. In addition, basins like Powder River, Uinta, and the Bakken are expected to also see slight growth. Finally, on the NGL side, we see 2024 averaging 6.6 million barrels per day and increasing to 6.8 in 2025. Production growth will be offset by flat ethane production in the short term, but Permian will drive propane plus production growth as an increase in demand is around the corner.
All right, thanks for that, Maria. Hey, for everybody on the call, clients, if you look in the bottom left, you'll see on every slide, we tell you where to find these products that we're looking at, and you can just click there when you get the slide deck afterwards. So keep an eye on that, and it'll take you to where you can find this information. So, Maria, the next thing we want to look at is some growth drivers. We've got data centers, LNG. Can you talk us through what we see in that really natural gas growth drivers?
Yeah, so the first one is increased demand. So now we have a more complex demand equation. Domestic demand will be driven by upcoming data centers, which will support steady gas demand through the end of the decade. We also have a higher exposure to international markets, which will be driven by the increase of LNG projects on the Texas and Louisiana coast. And by the end of next year, we expect total feed gas demand will exceed 15 BCF per day.
All right, thanks. And then we have some just technology growth drivers that we're seeing. You want to walk us through that?
Yeah, so similar as we mentioned in the Bakken, regions like the DJ and the Permian have been heavily benefited by a higher utilization of drilling technology. These include, but isn't limited to, longer laterals and multi-well paths, which get a reflect on different well-to-rig metrics, such as higher well per rig rates, lower spot-to-spot rates, and higher gas and liquid IP rates.
All right. So first things first, let's dive into our Henry Hub spot forecast. Maria, we see some opportunities here.
Yeah, so we see the price setting at 3.29 in 2025, almost $1 above the 2024 average of 2.31. As you can see in the graph, during the second half of 25, we forecast a higher price than the strip due to storage deficit. This higher price scenario will benefit tier 2 basins like Barnett, Eagle Ford, Green River, and Piceance. There is also opportunity for the Anadarko Basin to react, but this will only depend on how gas moves between South Texas and Louisiana hubs.
All right, appreciate that. Now we're going to walk through all the basins in the South or in the Gulf that we see. So, Maria, let's start with the Permian. We had some nat gas egress come online that freed it up, and then we see some additional growth there because of that. Can you walk us through our numbers?
Yeah, so we expect to have an average production in 2024 of 24.78 BCF per day of natural gas, 6.07 million barrels per day of crude oil, and 3.24 million barrels per day of NGLs. Across commodity, we can expect an average growth of 7% going into 2025.
All right, perfect. And Eagle Ford.
So the Eagle Ford, we expect an average production 2024 of 8.05 BCF of natural gas, 1.10 million barrels per day of crude oil, and 0.64 million barrels per day of NGLs. Across commodities, we can expect an average decrease of 3% going into 2025.
All right, and the one everybody is here for, I think, Haynesville with the infrastructure coming online. What are we looking at there?
Yeah, so the most relevant commodity in this basin is gas, and we expect average production in 2024 or 14.87 BCF per day. Across commodity, we can expect an average growth of 9% into 2025.
All right, 9% growth in the Haynesville. We'll talk a little bit more about this in the next section in rigs and then specifically nat gas, how we're going to feed all this upcoming demand, especially in the Haynesville LNG and data centers. So looking forward to it. Maria, as always, thanks for jumping on.
Thank you, Chris.
Thanks, Maria. Now let's bring in James Taylor, who runs our rig activity tracker. For those of you that don't know, we have for 11 years, we have tagged rigs to every G&P system in all the basins. And the reason that's important is because it gives us a good check and balance of production. So rigs are important. Where they flow in infrastructure is equally important. But what we're going to talk about today is how we see rig forecast is coming in the Gulf. James, thanks for joining us.
Yeah, good to be here.
So James, first, let's just talk about the Gulf. So we define the Gulf as Permian, Eagle Ford, and Haynesville. So can you tell us a little bit? We see some flat rigs in the Permian, but then we see the Haynesville really kicking off. Could you talk through what we're seeing in the Gulf?
Yeah, between those three areas, we're really seeing the Permian and Eagle Ford staying relatively flat, through the end of 2026, being that they're more, currently more crude focused basins. Where we see rigs really starting to take off here in the next year or 2 years is in the Haynesville. And that's with, the anticipation of a lot more demand coming online, a lot more egress, a lot more LNG expansions. So we see producers, reacting to the demand pull by increasing production in the Haynesville, especially.
Gotcha. So basically, we got some big sophisticated producers, and they're able to drill in the acreage and bring in wells online where the infrastructure is coming online. So let's move to the Permian. You said flat, James. Talk to us about our flat production in the Permian, kind of why we're seeing that.
Yeah, we see, fairly stable forward-looking crude prices, through 2026. And as you can see on the bottom, looking at the public and private rig counts, we can see in the last, 2 years that private rig counts have really decreased as the overall share of gross Permian rigs. And that's largely due to the surge in M&A activity that we've seen in the Permian Basin the last 2 years with, smaller private companies being acquired by larger public companies. And from what we see in the data is that these large public companies are electing not to retain the acquired rigs, while they're mainly focusing on, replenishing drilling inventories. So we have seen a decline in rigs in the Permian, but with increased operator efficiencies, longer laterals, high gas IPs, we still see associated gas in the Permian growing, through the extent of our forecast.
Thanks, James. Yeah, growth and flat rigs just goes to show how these large operators are looking at the market and their ability to adjust. One thing, James, I want to talk about, which I think is kind of cool, is the Permian public takeover, which is, I mean, back in 2002 or 2022, 50% were private rigs. That's really climbed.
Yeah, and this is just another way of looking at the graph on the previous slide, right? So we saw private rig counts really drop, in the past couple years, and this just is a representation of the share essentially that the public companies have now, right? So we've really seen that surge as there's less and less private operators in the basin, and their acreage positions have been acquired by larger public companies, essentially. So we're seeing the public companies, slowly take over this basin and just grab and operate a greater share of the rigs.
Yeah, that's awesome. Well, let's jump into what everybody's here to talk about, which is the Haynesville. The calm before the storm, James. We have quite the rig increase in 2025 coming, and that's to feed the infrastructure needs that are coming online.
Yeah, exactly. We've been talking about it for a while now with the demand pull that's going to come from the increased LNG demand on the Gulf Coast, essentially. So we've seen a lot of operators curtail production, essentially, as well as drop rig count, as you can see on the graph on the bottom left. While it's, to us, the data is showing that, public companies have really dropped rigs at a greater rate than private companies, essentially. But we're still seeing rigs in the area. We're still seeing, rigs drilling, essentially, but it's just operators are just building ducks, essentially, as well as curtailing production, as you can see from our throughput up on the top left. So yeah, with this upcoming infrastructure coming online in terms of LNG and increased egress capacity, we forecast a pretty healthy ramp in production, as well as a pretty significant return of rigs to the basin. With we see by the end of 2026 rig counts in the greater Haynesville area increasing by about 66%. So we do forecast a pretty healthy amount of growth here coming up relatively soon.
Well, it's where the action is. So let's talk about, you talked about rig counts up, and some people may say, hey, even with the rig counts up, that's not enough to feed production. But what we've noticed, and I'll move to this next slide, what we've noticed is there's still quite a bit of either wells that have been curtailed, and also inventory of drilled wells that are not producing quite yet. So we feel the Haynesville has that ability to jump into it. So this is basically a map of all the wells in the Haynesville, and then we overlaid kind of the future infrastructure coming online, where it sits. And you can see the infrastructure is right at the core, right where those wells are. So could you walk us through kind of, hey, we think production is going to be just fine in the Haynesville?
Yeah, it's been pretty well publicized by large public operators that they're holding a lot of production back, right? Waiting for uh, an economical return of gas prices. And as well as what this map shows is that there's a lot of wells that are drilled but not producing yet. So this just goes back to show you that, we still have a good amount of rigs drilling in the basin, but operators are just electing not to complete or turn these wells in line yet. So, combination of curtailed production, drilled non-producing wells, as well as our forecasted rig ramp here coming up in 2025. We think that Haynesville producers will be able to fill this upcoming infrastructure relatively quickly with the combination of those three factors.
Yeah, and also timing is also a great opportunity for folks, especially traders, to make some money. And it'll be interesting to see how this all plays out with when the infrastructure comes online, when the LNG comes online, and then also what we'll be talking about in our nat gas section is demand from other areas such as data centers and residential utilities, commercial utilities, to supply that. So the last part of the story, James, Eagleford, the rig story seems much like the Permian. We've got production growing, rigs declining to flat. Let's end it with the Eagleford story.
Yeah, sort of a similar story, right? We're seeing not as an extreme decline in rigs as we saw in the Haynesville or in the Permian in the last few years, but rigs are still declining in the Eagleford. And as you can see in the chart on our top right, we do forecast rigs ramping, in about 2027 to fill a lot of the LNG demand that's going to come online in terms of Freeport, Corpus Christi, Rio Grande, and Texas LNG. So we anticipate a lot of operators are going to ramp in the gassier window of the Eagleford and start producing there as, gas economics become more favorable and there's a lot of demand pull from the Gulf Coast.
Awesome. James, appreciate the time. Everybody online, this is something we do weekly in our rig activity tracker, tying these rigs to systems to give us a good, accurate idea of production. James heads that up, and this is what we're looking for in 25. Thanks, James.
Thank you.
All right, so we just covered the rigs. Thanks, James, for doing that. Gage, let's bring in Gage. Gage is our crude analyst. You heard him speak on the Bakken webinar we just did on those dynamics with the double H conversion. And Gage, welcome to the Take Me to the Gulf webinar.
Thanks, Chris. I'm excited to talk about these Permian dynamics.
All right. Well, let's first, just like we did with NGLs, let's kick it off to the kind of, hey, all is quiet on the home front. Flows going to Corpus and Houston. And so really just kind of want to look at your views on this. I don't think much has changed over the last year from our views on Corpus to Houston flows.
Yeah, so I mean, if we look at our production, which we had Maria touch on, I wanted to look at the infrastructure side of things now. And so Corpus remains the premier destination for Permian crude oil. Those egress are about 92% utilized and are forecasted to be between 93 and 95% utilized in 25 and into 2026. The Houston pipes are around 75% utilized right now. A lot of what's pulling that utilization down is BridgeTex, but we forecast that to become tighter with our Permian growth outlook. So, Chris, there really isn't a whole lot going on here, but where the story really gets interesting is with the northbound flows to Cushing.
Gage, I think they call that foreshadowing. So let's jump into the northbound dynamics here. And so, all right, Gage, everything going north seems cyclical, seasonal, and now we have it smoothing out. over time. So you made the point that flows to Corpus and Houston are going to continue as expected, and there isn't much to note there. But the historical flows to Cushing, I mean, this is factual, have been cyclical, but we have it smoothing out. So what is changing in our forecast to cause this increased demand?
Yeah, and Chris, those are some good questions. To provide some context, Cushing is a critical infrastructure hub and serves as the designated delivery point for those WTI futures contracts. And Cushing's demand is focused predominantly around blending, storage, and in-state refining. And really, there are two parts to your question around what is driving the increase to Cushing. The first one is the forecasted tightening of Permian egress to Corpus and Houston, which is naturally going to push some more barrels north. And then the second is we're going to have to really look at the crude quality that's being delivered, which is a light, sweet barrel, and kind of what other dynamics in the U.S. are changing as well.
All right, let's move to those other dynamics here. Let's go back up to what we talked about last time, which is the Rockies. And you say footing gets loose in the Rockies. Can you explain that a little bit?
Yeah, so I'm not going to go in very deep here. We touched on it pretty heavily in the last webinar, but at a high level, we're ultimately going to see those lower volumes from Bakken to Guernsey, Guernsey to DJ. And that's largely in part of Kinder Morgan's Double H pipeline converting to NGL service in the first quarter of 2026.
Okay, well, so we talked about that. You got everybody on the webinar. You can go back and download the last webinar, but let's bring it down a little bit. So let's move down to the Cushing costs. You talked about the type of barrel, things like that. So let's keep moving down the value chain.
So now looking at the volumes from the DJ to Cushing, we're forecasting these volumes to also decline. So with lower supply from the Bakken and Guernsey and the DJ's local production, which we're forecasting to decline substantially, there's just simply less volumes that can be moved on to Cushing. And so going back to the quality spec I mentioned earlier, this volume is traditionally the light, sweet barrel from the Bakken, as well as the Guernsey light barrel. Cushing is utilizing these barrels for blending, which ultimately leads us back to the Permian.
All right, so we started with the Permian. We went up north. Now we're headed back. Let's talk about what you're seeing, and then this explains those northbound volumes.
It does. So with the decreased light, sweet volumes from the Rockies and from the Bakken, the Cushing demand must be fulfilled through another source. And this source is and is going to continue to be the Permian. And so this is something we've already started to see on Basin Pipeline, as we're showing here in this visual, but then we're also forecasting it, and that we're going to continue to see it moving forward.
Well, as usual, always interesting dynamics. So we also cover midstream company financials. Gage, you do as well, since as you're a crude analyst. So if I'm watching for companies that are able to capitalize on this upcoming dynamic, who would that be?
On the equity side, Plains is the operator here. They're the operator of Basin Pipeline. And so to capitalize on this dynamic going into the future, Plains is the operator to watch.
All right. Well, that was nice, quick coverage of crude that's going on in the Gulf. As usual, part of this webinar is to just get everybody thinking on dynamics, and that opportunity exists everywhere. So if you have questions on it, please feel free to reach out. You can also scan that QR code in the bottom. Gage, always good having you involved in these conversations. Thanks for joining us.
Thank you for having me on, Chris.
Let's bring it back to, or let's bring it to NGLs and talk about what we're seeing in NGLs. As usual, and what we're going to be talking about a lot is there's always opportunity, and commodities are tied together. So we're going to bring back Maria from our production segment. Maria, thanks for joining us.
Thank you, Chris.
Well, first things first, let's kick it off by just looking at NGL Gulf egress, everything looks fine.
Yeah, so there's plenty of space just in time. New NGL capacity of almost 1.3 million barrels per day of wide-grade NGL have started to open since the beginning of 2024, and this will continue till the end of 2026. This translates to around 400,000 barrels per day of propane supply capacity from the Permian opening up. And it's important to note that the Daytona pipeline is already online and has ramped up quickly in throughput.
Okay, so everybody here, everything looks good on egress, and everybody's like NGLs are fine. But what we've been talking about, especially in the Bakken section, was hey, those that control the molecule really have optionality to make money as demand spikes. So I'm going to move to the next slide, which is really talking about control the plant, control the molecule. So what are we seeing from just who has the plant and how people are capitalizing here?
Yeah, so basically, as you mentioned, with supply chain integration becoming more common in basins like the Permian or the Bakken, operators have control over the molecule. And in low commodity prices scenarios, they can control rejection and recovery from the raw mix to maximize their profit. It's once again, as we would been mentioning, commodity production tying up together. As you can see on the graph, ethane volume saw a spike at the end of 3Q24 due to tight gas egress from the Permian. Additionally, record ethane production from the Northeast, as reported by producers like Range Resources, EQT, and Antero, contributed to the increase. While the full ramp of the Matterhorn pipeline and reduced maintenance are expected to lead to some ethane rejection in the gas stream, ongoing eastbound gas constraint before the Blackcomb pipeline comes online, keep EDA bullish on ethane volumes through the second half of 25.
All right, thanks. So control the plant, control the optionality, which is why we see egress pipes being built, even though folks would say they don't need them, but you control the molecule all the way through the frac. So let's move on. Maria, let's look at the frac. Frac is tight, as we can see.
Yeah, so while US ethane production, consumption, and exports have set new records, Mont Belvieu infrastructure has struggled to keep pace with its rising supply. The value of an integrated system has shifted from upstream to downstream, and producers find now benefit in a constrained scenario as the growth is starting to come from international demand. So moving the gas to the dock end up leading to higher revenue and increase in LPG exports. In other words, the spot and marketing upside that we're seeing now will translate into long-term fee-based contract and under new export capacity from those Mont Belvieu facilities.
All right, Maria. Well, short and sweet. We're going to keep the NGL section short. There is opportunity there, and I would encourage, as I talked to everybody, or I told everybody about, we're coming out with a written section kind of end of December, and we will discuss how controlling the molecule gives you optionality and upside to revenues in that as well. So Maria, thanks for joining us on both production and NGLs on this webinar.
Thank you, Chris.
All right, let's welcome in Zach Kraus, who not only is one of our awesome analysts, but has also taken on heading up our data center new product and also looking at data centers for our clients, which is super interesting to us. Zach, thanks for joining us.
Yeah, thanks, Chris. I'm excited to be here and have this conversation.
All right, man. Well, let's kick it off. We've been developing a macro and micro level view on the impact of data centers will have on the U.S. gas demand on the lower 48. Zach, this has been a huge topic of conversation, both internally, we're just excited to talk about it, and externally, hey, what are the opportunities that exist for our clients? So first, hey, can you kick it off with an overview of the product and kind of how we're looking at this dynamic?
Yeah, absolutely. So this heat map reflects the first steps we've taken in scoping the growth that will be provided through data center demand. In our first pass, we created a data set that has the location and load information for 304 data centers across the lower 48.
Okay, 304 data centers. Now, what everyone wants to know, Zach, and you've done a ton of work on this, is what does that translate into power needs?
Yeah, absolutely. So those 304 data centers have an estimated IT load of 85 gigawatts. And then when you apply a power usage efficiency assumption, or PUE, to account for non-IT loads such as cooling, lighting, HVAC, etc., that 85 gigawatts increases to 115 gigawatts. And then, if that total load of 115 gigawatts was entirely served by natural gas, it would translate to an incremental 18.4 BCF a day. Of course, that's not really a realistic assumption. We get to that about 40% of that 115 gigawatts will be served by natural gas. And this baseline assumption comes from the generation portfolios reported to the EIA in 2023. If only 40% of the new data center demand is served by natural gas, it will result in an incremental demand of 7.5 BCF a day.
Okay, so let's just stick with that number, 7.5 BCF. That's our base demand assumption. So as usual, there's always an upside demand scenario, which hopefully I think everybody on this call is looking for. Talk to us about the upside demand.
Of course. So there's upside to that 7.5, like you said. And that comes from the 304 projects that were counted as of the end of August 2024. And each week we're seeing more projects announced. And even though it's not included in our official tally, there's considerable upside to that figure from these projects that have been announced between now and August. Additionally, the pace at which demand is growing is leading to some data center developers wanting to bypass waiting in line on these tie-in queues to get behind the utility, and they're investing in co-location or on-site generation opportunities. And from what we understand, the heat rate associated with these smaller co-located generation facilities is much higher than that of a utility scale generation opportunity, and that would push our estimate up further.
All right, so that's a pretty darn good upside, and we can't look at the upside without looking at a downside case. In our macro nat gas product, we only include 4.2 BCF a day. Can you talk a little bit more about why that is?
Yes. So as you said, in the macro, we're only accounting for 4.2 BCF a day of incremental growth from data centers between 2023 and 2030. And that's primarily due to limitations of existing infrastructure and generation machinery. We already see shortfalls being projected in some ISO resource adequacy studies that in the short term. So those meaning the ones that are out this year. Just between coal retirements and incremental growth in demand we see between 24 and 25, we're already projecting some shortfalls in some locations. So that 7.5 BCF a day number does not place any of the projects, any of those 304 projects at risk of not coming online and being served generation capacity by 2030. And as is the case in developing projects, sometimes things fall behind schedule. And given the current state of US generation capacity, there's additional investment that's needed to bridge the gap between what we have currently and what would be needed to serve all these new data centers. And until that investment's made, we're going to continue to risk some of the volume that data centers would add to US gas markets.
Awesome. Thanks, Zach. All right, we looked at the upside and downside cases. What we're really want to talk about, though, is location. So, because location does matter in this case. So can you talk a little bit about what we're seeing for location?
Yes. So as we zoom in from the macro level, we can see that the dynamics of data center demand are highly localized. There are hubs that we see developing in Texas around the Dallas-Fort Worth area and between Austin and San Antonio, as well as around the Atlanta area in Georgia, Maricopa County in Arizona, in central Ohio, and of course, we're seeing the lion's share of these projects being announced in the Northern Virginia area, which had the largest data center market in the world prior to the explosion of this theme, call it 18 months ago. And as I mentioned earlier, we're developing this tool to serve analysis at the macro and the micro level. The data backing these visuals isn't just state and county location data, but it's also latitude and longitude data for each data center location that we were able to pair then with pipeline footprints that we got from our partners at RexTag. And this level of granularity has helped us understand asset level exposure to data center demand. And we begin to be able to layer this into our company level intelligence for those companies in our equity coverage group.
Awesome. Thanks, Zach. So location matters, and we are developing that tool, but we're here to focus on the Gulf. And so in the Gulf, very interesting dynamics are coming into play. We now have 3 competing factors for natural gas. So can you walk us through just the Southeast and the Gulf in general and what we're seeing from data centers and what they're contending with?
In the Southeast, data centers are going to be contending with 28.2 BCF a day of feed gas that East Daily estimates will be required by the year 2030, as well as the growth in demand from existing and expanding utility customers. So there's rapid growing markets in the Atlantic coastal states for gas-fired generation from utilities like Duke. And we see these growing utilities supporting projects like Southeast Supply Enhancement, or SSE, on Williams Transco Pipeline, and the South System Expansion 4, or SSE4, on Kinder Morgan's Southern Natural Gas System. So SSE will help bring an incremental 1.6 BCF a day into the Southeast, while SSE4 will increase deliverability into Alabama and Georgia by 1.3 BCF a day. These projects will help gas enter the Atlanta area that is experiencing considerable load growth attributable to data centers. However, these projects began their commercialization process a bit before the explosion of this theme, meaning that East Daily still sees some opportunity for additional large-scale expansions that will deliver gas into the Southeast. So this then brings on a second wave of projects, including Boardwalk Pipeline's Cosi Junction on the Texas Gas Transmission System, Kinder Morgan's Mississippi Crossing project on Tennessee Gas, and Energy Transfer's South Mississippi expansion on the Energy Transfer Interstate Holdings assets. These projects are going to be really important to help serve growing demand in the Southeast while also serving LNG demand in the Gulf Coast. With each of these projects delivering between 1 and 2 BCF a day of gas from east to west, it is yet to be seen which combination or all of the projects that the market will be able to support. And these projects are going to be essential for providing stability at the Transco Station 85 and FGT Zone 3 price points. Each year, the Florida gas market already finds itself tight, leading to premiums at each of these price hubs. And then, when Plaquemines begins to ramp, the tightness will only increase. Add in the factors of data center demand in Georgia and the growth of utility demand in the Carolinas, and you can see that these competing demand factors are placing extreme pressure on the Southeast markets. Timing is everything in balancing supply and demand, and with these 3 east to west demand pull projects not coming online until 2028 and 2029, EDA sees opportunity for increased volatility at Transco Station 85 and FGT Zone 3 in the near term. And of course, this data isn't limited to just one storyline. It has also allowed East Daily to see the way that data center demand has aided to the potential FID of Warrior. Energy Transfer has indicated that the FID of this project will be coming any day now. And in the past, eastbound Permian egress pipelines have been built on the merits of supply push. And given the recent announcements of Blackcomb and the GCX expansion, the need to move associated gas out of the basin, it seemed to be satiated in the near term. But the expansion of data center markets in the Dallas-Fort Worth area has created a demand pull factor that Warrior is very well suited to serve. Chris, we're really pleased with the insights that we've been able to pull together from this new data set, but data centers aren't the only part of the story. So I'm going to turn it back over to the commodity teams to continue our tour of the Southeast Gulf.
Yeah, thanks, Zach. So for everybody on here, you can see in the bottom right-hand corner, there's more information if you want to know about kind of how we're looking at data centers. But Zach, we're going to get to Oren next on a nat gas, but this all plays in. It's getting really exciting in the Gulf, and there is tons of opportunity. So thanks for joining us on this, Zach, and thanks for all your insights on data centers.
Of course. Happy to help.
All right, for the finale here, let's talk about, we're going to get into what what we think at East Daily are the most interesting dynamics, which are the natural gas dynamics. So, going to be the longest section. We're going to get into pricing, we're going to get into infrastructure, and we're going to tell a story. Joining me here today is Oren. Oren, you cover the Southeast and the Gulf natural gas products. Thanks for joining me today.
Yeah, thanks for having me, Chris.
Yeah, so for everybody on here, timing is everything. So you have production timing, you have infrastructure timing, you have demand timing. So we're going to take you through a story. And the first thing, we're going to start in the West, in the Permian, and we're going to go all the way through to Transco Station or Zone 4, Station 85. So first things first, Oren, the Permian. We see some upside with to Permian pricing, to Waha pricing, because of some maintenance being done and that some infrastructure being built. Can you walk us through that?
Yeah, happy to, Chris. So, yeah, despite Matterhorn filling faster than any pipe in Permian history, maintenance events have kept Waha low. However, we do see upside opportunity through 2025 as constraints ease out of the Permian. And then, there's downside opportunity in the winter as well as Mexico demand wanes and those capacity constraints rear their ugly head again. Starting in 2026, we again see some upside to the forward curve as GCX and Blackcomb provide, roughly 3 BCF a day of much needed egress out of the basin.
Thanks. And on that right hand visual there, you see eastbound. You were nice enough to let everybody know by the stars when we see that opportunity. So for everybody, what you're looking at there is you're looking at the black line is eastbound capacity. And whenever you see a constraint in capacity, that's when we see opportunity, either a constraint or a disconnect. So, Oren, thanks for sharing that. Let's take a journey now down to the Houston Ship Channel, where things are a little bit different, where we see downside because of the push from Waha down to the Houston Ship Channel.
Yeah, thanks, Chris. So, all of this egress capacity puts Houston Ship Channel in a sticky spot. We expect to see downside pressure to Houston Ship Channel basis in the winter with weak demand from Mexico and capacity constraints towards LNG demand in Louisiana. As Houston Ship Channel becomes oversupplied, this route between Houston Ship Channel and Louisiana is going to run full. And, as capacity constraints arise, we expect to see Houston Ship Channel trade at a discount to Henry Hub. This problem should be alleviated, assuming that Kinder Morgan's Trident intrastate makes FID, turning on a release valve for Houston Ship Channel starting in early 2027.
Great. So we have a release valve at the Texas-Louisiana border coming online. But one of the other drivers of our forecast is LNG and incremental. I wouldn't even say it's incremental anymore. It's a lot of LNG demand. And with the new administration, things have been shooken up a little bit. We had a pause, and now maybe we have a quicker ramp. So can you walk us through our updated LNG forecast?
Yeah. With a shift in the political landscape comes some pretty big changes to our LNG forecast. The Trump administration plans to resume DOE export approvals on day one, which would add 4 BCF a day to an existing ramp of over 14 BCF of incremental capacity. And, 9 BCF a day, about half of that total 18 BCF of new demand is slated to come online on the Louisiana Gulf Coast between Port Arthur and Plaquemines LNG.
Well, dynamics are shifting. All right, so we have LNG demand coming online, and now, Oren, let's move into what has become the most popular slide we've ever created, which we call our super build slide. And we're going to really dig in to the Texas-Louisiana border and then the Louisiana-Mississippi border as we move east.
Yeah, thanks, Chris. So starting in 2023, we've seen a load of new egress capacity out of the major growth basins, the Permian and the Haynesville, and there just wasn't sufficient demand to soak up that supply, which led to the, current oversupply situation we're dealing with now in 2024 with these, historically low gas prices. The problem is, moving forward, we see potential for history to repeat itself. Gillis supply capacity is forecasted to reach over 17.5 BCF a day in 2027, assuming Trident makes FID. And so that's inbound flows from Houston Ship Channel, as well as flows south from the Haynesville. However, LNG demand capacity is only expected to reach roughly 12 BCF by year-end 2027, 4 BCF incremental over demand today. And so with a slew of new pipeline projects in the works, we see the likely scenario where capacity into Gillis is overbuilt until 2029 at the earliest. And if producers grow into this capacity too quickly, we could see a repeat of the gas oversupply situation we're currently seeing at Henry Hub.
All right, real quick, you mentioned 2029, some egress pipes. If you look in the upper right-hand corner, those light blue, they don't make the timeline because they just got announced, but those are all the announced egress pipes we could see coming online. Is that correct, Oren?
Yeah, exactly. So there is relief on the horizon. During this last round of earnings, 3 separate projects were announced. Announced open seasons to cross Mississippi, which would connect Haynesville supply to the Station 85 market, where we actually see the opposite problem, a market that's short gas.
Well, let's get there. This is where it all converges. Station 85, Transco, Zone 4. As we talked about earlier, you have 3 competing factors now for gas. You got LNG, you got data centers, and you just have residential commercial demand in general. So you have a pool back there at Gillis. So you went from the Permian to the Houston Ship Channel, then to Gillis. And now we need to get it over to where it gets really interesting, which is this Zone 4 of Transco.
Yeah, exactly. So you just got to keep the lights on. And so the problem is at Station 85, you've got 5.5 to 6 BCF a day of demand from Florida that's not going away. Incremental 3 BCF of LNG demand at Plaquemines, also pulling from Station 85, and half a BCF a day of potential demand from Georgia data centers, which is going to pull directly off of Transco. And so the issue is that you just simply don't have supply capacity to meet all of this new demand. We don't expect to see any new supply capacity before 2028. Those new projects crossing Mississippi are slated for early 2028, and until then, we see significant upside opportunities at Station 85 during the summertime when Florida demand pushes demand pull over that potential capacity.
Awesome. Thanks, Oren. So just to recap here, Permian, we see some upside. Houston Ship Channel, we see opportunity on the downside. Gillis, we see some up, and then Station 85, we see some upside to this story. So again, timing's everything. Production, infrastructure, and demand all coming on. So Oren, thanks for joining us today. Appreciate the time.
Thanks for having me, Chris.
All right, everybody. Thanks for joining us today in our Take Me to the Gulf, our DLS section, part 2.
if you see this slide and you look at the bottom QR code, we are doing a written report, and it's going to be very interesting. We're going to explore some themes we see coming in the future. I'll seed you with a few of them, or actually all of them. So one we're going to be covering is integrateds getting more integrated, calling it Bring Back the 80s. Next is power burn, the impact of data centers on the demand, nat gas demand structure. And then the third section is, how does private equity fill the void of infrastructure, and what does that look like? So I encourage everybody to scan that code and sign up to receive the written report, which will be out towards the end of December. Again, sign up for any of our weekly blogs. They're all on here. These are all free, and it's really good content. So thanks for joining us on Dirty Little Secrets, and we will see you on the next one come February, and make sure to sign up for the written report. Thanks.